All right, let's talk Land's End. They just dropped their latest earnings, and, well, the market's initial reaction was not great. But behind that knee-jerk drop, there's a really interesting tug-of-war going on between the headline numbers and a major strategic shift. So we're going to break it all down, look at management's game plan, and figure out what this all means for the stock.
And the story really kicks off with this number. Right out of the gate, in after-hours trading, the stock took a 4.2% hit. The market heard the news, and its first impression was a definite thumbs down.
So that begs the question, right? Why the drop? Was this just a simple case of bad numbers? Or is there something more complicated happening under the hood? Is there maybe an opportunity here that the market is missing? Let's dive into the data and find out.
Okay, here's what spooked everyone. It's a clear miss on both the top and the bottom lines. Adjusted earnings per share came in at a loss of 6 cents, when Wall Street was expecting a loss of only 3 cents. And revenue? It missed by a pretty wide margin, about $28 million. You know, in the world of earnings, a double miss like this is almost guaranteed to get an immediate negative reaction. But that is not the whole story.
Because if you dig just one layer deeper, you find this number, which totally contradicts the bad news. Gross margin actually went up by 90 basis points. That's nearly a full percentage point. It means for every dollar of stuff they sold, they made more profit, even though they sold less stuff overall. This little number right here, it's the key to understanding management's entire argument.
So how does that happen? How can you miss on revenue but make more profit per sale? Well, to solve that puzzle, you have to look at where the money is coming from, because what we're seeing is a huge split in performance between the company's different sales channels.
And here is the main culprit for that big revenue miss. Their core business, U.S. e-commerce, was down over 11%. Ouch. Management's reason was a slow start to the super important swim season. And for a brand like Land's End, a weak swim season is a massive headwind. It's a big deal.
But while their own website was struggling, check this out. Other parts of the business were firing on all cylinders. The outfitters business, that's stuff like school uniforms and corporate apparel, that grew over 5%. And even better, sales on third-party sites like Amazon and Macy's, they surged by more than 14%. Now, this isn't an accident. This is a strategy in motion.
And you don't have to take my word for it. The CEO, Andrew McLean, spelled it out himself. The goal is to reposition the brand via a sophisticated distributed commerce model. Fancy words, but what it really means is they're trying to meet you wherever you're shopping, instead of just waiting for you to come to their website. This is the absolute core of their new playbook.
And this big strategic pivot has a name. They call it the asset-light model. Management spent a ton of time on the earnings call hammering this point home, arguing that this shift is making the company healthier and way more efficient, even if that manned revenue number looks a bit ugly right now.
And they brought the receipts to prove it. Look at this. Inventory is down for the 9th quarter in a row. That means less cash tied up in warehouses and less risk. High-profit licensing deals are up a whopping 19%. They also talked a lot about focusing on higher quality sales, meaning they're not just chasing every last dollar, they're chasing the more profitable ones. The message they're sending is crystal clear. Profitability now matters more than just growth for growth's sake.
So you see the fundamental disconnect here, right? It's like two different conversations happening at the same time. On one side, you have management talking about their strategic wins, the asset-like progress, those margin gains, the growth in new channels. But on the other side, you have the market, at least at first, just staring at the old-school report card, the revenue miss, the EPS miss, and the weakness in their main online business.
Okay, so that's the story of what just happened. But what about the path forward? Let's look at what the company is promising, their guidance, and the big challenges that could get in their way. So here it is, their updated outlook. For next quarter and for the full year, they're guiding for a return to profitability and for revenue to start growing again from where we are now. These are the new goalposts. The big question, of course, is can they actually hit these targets? Because there are still some major wildcards in play.
And that guidance doesn't exist in a vacuum. You've got 3 big things to watch. First, tariffs. Management says they've baked the impact into their numbers, but you know how quickly that situation can change. Second, and this is the big one, the company is in the middle of a strategic review, which could mean anything from a sale to a merger, and there's no timeline on that. And finally, there's just the general health of the consumer, which is, still a bit of a mixed bag.
All right, let's put it all together. We've heard the good, the bad, and the uncertain. So based on everything we've seen, what should we expect to happen next? And more importantly, how do we rate the stock today?
So here is our call. For the next earnings report in Q3, we actually expect revenue to land right inside their guided range.
maybe even towards the high end. Why? Well, some of those delayed swimwear sales should show up. Plus, you'll be getting into the start of outerwear season. As for the stock price itself, we think it's going to trade sideways for a while. The story is just too balanced right now. Good operational moves versus weak top-line sales. The stock's kind of stuck in neutral until a big catalyst comes along. And that catalyst is almost certainly that strategic review.
And that brings us to our official rating. We are calling this one a market perform. In simple terms, that means we expect the stock to perform pretty much in line with the overall stock market. No big outperformance, but no big underperformance either, at least in the near term.
And here's exactly why. All that progress they're making on margins and the asset-light strategy, that's putting a nice solid floor under the stock price, preventing it from totally collapsing. But that nagging weakness in their main e-commerce business is acting like a ceiling, capping any real upside for now. And that whole story is just sitting under the shadow of this wait-and-see strategic review. Until we get an answer on that, it's really hard to see the stock making a big move. The valuation today seems to pretty fairly balance all of these competing forces.
So ultimately, the story of Land's End really comes down to a test of patience. The company is making what look like the right moves operationally, but the market is still waiting for that top-line growth to come back. The real question is, will investors get rewarded for waiting out this turnaround, or will that strategic review provide a big catalyst first? We'll have to wait and see. This is not financial advice.